Hi, folks. Welcome to our discussion of Chapter 29 on the monetary system. Um, monetary system, money, of course, is an important part of the macroeconomic system. So this is a pretty important chapter in our discussion of how the economy works in the long run, how the macroeconomic system works in the long run. So got a lot of stuff to talk about in this chapter. So let's get right to it. I'm going to go to my PowerPoint presentation here. We'll move right along. A lot of this stuff is in the book, but I think this stuff up front's not complicated, and you can just read in the book and get it. But I want to just mention a few of these points because they are worth mentioning. They are kind of interesting and they're important to reflect on, even if they're not all that complicated. But first thing, money. Money is not just green dollar bills. Economists define money much more broadly than kind of the average Joe. Money, any asset that people normally use to buy goods and services. Can be a lot of different things. Just think for a second about how money evolved. Originally, when you kind of think back 100,000 years ago, a caveman society, cavemen didn't have money. They didn't specialize in the production of a particular good, and they didn't trade for other goods. They were just all self-sufficient. Each little group was self-sufficient. Now that's not efficient, and that doesn't lead for a very high standard of living. That's the way it was. So if there's no specialization in trade, there's no money, because money's fundamental role is to facilitate trade. Anyway, once we started to find that specialization in trade was far more advantageous, we started to just barter. Barter means that you just trade goods and services directly. I produce more watermelons than I need, but I want cantaloupes as well. You specialize in the production of cantaloupes. You want watermelons though, so we trade watermelons for cantaloupes. That's barter. We just trade directly. But barter is it's got a lot of hassle to it, right? It's not a very smooth or efficient system. I think that's probably pretty obvious. So humankind figured out pretty quickly that we need to find something else that's better than a barter system. So the first types of money had intrinsic value, things like seashells or beads or some kind of thing that you can find out in nature that's somewhat rare that you can use to facilitate trade. But the first forms of money had some intrinsic value. That means they had some value in and of themselves. Next, we move on to gold. Gold becomes kind of the main form of money for millennia, and gold is still used to some extent as money. And then eventually we get to this system where, banking starts to develop. I put my gold in the bank and I get a piece of paper that says, okay, this piece of paper is worth 1 ounce of gold at this bank. So I'm going to buy something from you. So I'm going to take my banknote. I'm going to go to the bank, get my gold, give it to you, and then you take it and put it in your bank, and then you get a banknote from your bank. We figure out after some period of time, we figure out that it's just easier for just me to just give you the banknote, and then I don't have to go to the bank and you don't go to the bank. I just give you the banknote and we just skip the whole going to the bank process. That's much better. And so the first types of kind of paper money were like that. They were banknotes and they were tied to gold, right? There was gold in the bank that was connected to this banknote, and we just traded in the banknotes and the gold just stayed in the bank. But eventually that tie was severed. This has a long history, and I'm skipping over many, many steps, but eventually that was severed, and we get to what we have today, which is fiat money, money that has no intrinsic value. Money today is not tied to gold. It's not tied to anything. Money today is purely fiat money. That means it has no intrinsic value. Money today is only valuable because we accept its value, period. End of story. Money is only valuable because we accept its value. That's weird, but that's the fact. And then the last kind of evolution in this story is most money today is just electronic. Most money today doesn't even have paper connected to it. It's just a number on a computer somewhere. That's all that the vast majority of money is today, just purely electronic money. Money has three functions. First and foremost, it's a medium of exchange, right? We just use money to facilitate exchange. That's money's fundamental value. And I think that should be pretty straightforward. It's easier to have money than it is to barter, as we were just saying. Second thing, money is a unit of account. It's just a good way to track value, to keep track of numbers. If I say, hey, you have a watermelon over there, how much do you want to sell that watermelon to me for? We could express that in many ways. You could say, well, you could work for me for an hour. Or, oh, you could give me a pound of blueberries. Or, oh, you could give me 2 gallons of milk. There's a lot of different ways we could express the value of the milk, of the watermelon. But it's just easier to just express values in terms of money. It's a common unit of account that we can all use and rely on, and it's very, very straightforward. And then the third thing is money is a store of value. If you have savings that you want to use at some point in the future, you can put savings in different places. You can put savings in real estate. You can put savings in stocks or bonds. You can put savings in whatever. Money is a straightforward place for you to store your value as well. However, money is an imperfect store of value because it loses value over time, right? We have inflation taking place, so the price level's rising, so the value of any given sum of money is eroding over time with inflation. So money's an imperfect store of value. People still keep some of their value in money because it's so liquid, right? Liquidity is the real benefit of having your value in money, right? Liquid means how quickly, how easily can you convert your wealth to the stuff that you want to buy. And money is the most liquid form of wealth. If I have my wealth tied up in precious art, right? If I have this famous Picasso painting, and if a huge chunk of my wealth is in that painting, it's a lot of trouble for me to convert that into the goods and services that I want to buy. That means that's not very liquid. It's still a store of wealth, but it's not very liquid. On the other hand, money is extremely liquid. So that's why some people keep money, or that's why most people keep money, or everybody, despite the fact that it's imperfect, they keep it because it's so liquid. We have two different measures of the money supply. Later in the class, we're going to talk about kind of how much money there is in the economy and why it's important to kind of keep track of that. So we have two different measures for how much money there is in the economy. They're very creatively named. The first measure is named M1. Really exciting, sexy name there, M1. M1 measures like obvious stuff. It measures currency. Everybody knows that we should count currency, you know, dollar bills, coins. Obviously, that's money. M1 includes currency, and it also includes demand deposits in a bank. So demand deposit is a deposit that you can just go in and just withdraw at any time. No penalty, no nothing. So a checking account, for example, and many savings accounts are demand deposits. You just go and withdraw them anytime. M2 is the broader measure of the money supply. M2 includes everything that's in M1, but it also includes time deposits. And time deposits are deposits in the bank where you can't, you know, your money's there, but you can't withdraw it until a certain date without a penalty. So if you have a certificate of deposit, that's the perfect example here. If you have a certificate of deposit, you know, that's money in the bank, but you can't withdraw until a certain date. So it's not as liquid as a checking account or most savings accounts. So CD is a time deposit. That's included in M2, and also money market mutual funds are included in M2. Now, as we said last chapter, mutual funds aren't money specifically, but a money market mutual fund is a mutual fund that's only invested in very short-term bonds that are going to mature very soon, like days. It's called commercial paper. Money market mutual funds are invested only in bonds that mature very soon. So money market mutual funds are very low risk. It's very unusual for somebody to lose money in a money market mutual fund. It has happened before, but it's a rare thing, and the economy is in trouble when that happens. But money market mutual funds, even though they're not money in a strict sense, the fact of the matter is they function a lot like a checking account. So money market mutual fund balances are also counted in the M2 measure of the money supply. So which measure is right? Should we just consider the things in M1, or should we also consider the additional items that are in M2, right? Of those kind of less liquid items like time deposits and money market mutual funds, should they also be counted as money or not? Pause, answer that question. Okay, now you're back from the pause. The answer is we don't know. We don't know if those other things should be counted or not. If we knew for sure, we just have one measure and that would be the end of the story. But so because it's not clear, 100% whether those additional items should be counted, we have two different measures of a money supply. That's kind of the whole point there, and we track both measures. For our purposes, the measures move together similarly though. The level, right, the number of M1 and M2 is very different, right? M2 is obviously a lot bigger than M1, but what we focus on more, which we'll talk about later in the course, is not kind of the level, but how rapidly are they growing. And for our purposes in this class, the growth rate in the two measures is similar enough that we're not going to worry about that. You can worry about that in a more advanced money and banking class if you were to take more economics at a higher level later on. So the Federal Reserve System. The Federal Reserve System is a big part of this chapter, and it's a big part of kind of everything that we're going to discuss from here on out in the rest of the course. We'll talk about the Fed probably about every day from here on out. So the Fed is the central bank of the U.S. So by central bank, this is where banks keep their money, okay? They keep their money at the Fed. Now banks have some cash in the vault. If you go to any bank, it's going to have cash on hand, but I'm not talking about that. I'm talking about the other reserves that the bank keeps on hand beyond cash. If you don't, I hope this is straightforward enough, but if you deposit money in the bank will loan out most of that money. That's what the bank does. That's the whole point of having a bank, is to take that money and to loan it back out. But the bank's going to keep some of that money on hand as reserves. And so some of those reserves will be in cash, but the rest of the reserves will be in the commercial bank's bank account at the Fed. Does that make sense? That's what it means to be a central bank. It's the bank where commercial banks have their bank accounts, aside from the cash that they have on hand, obviously. The Fed is a pseudo-government body. It's part of the government in some ways, but in other ways, it's kind of not part of the government. The Fed is a unique system, or the central bank just in general is a unique system, and there's no other kind of example of an entity like this that is part of government, but is not really government in a lot of ways. So a pseudo-government body. The Fed's three roles. First off, it regulates commercial banks. Commercial banks are regulated heavily, right? Commercial banking is one of the most heavily regulated parts of our economy, and there are several different entities that have regulatory oversight, but the Fed is one of those entities, and they have a lot of rules that they set that commercial banks have to follow. But one of the rules that the Fed sets, just as an example, is the Fed sets reserve requirements. So again, if a bank gets $100 in deposits, bank is going to loan most of that money out. But the Fed will actually set a percentage, and the bank has to keep that percentage of the money on hand. The bank can't loan all of its money out. It has to keep a certain percentage on hand. That's the reserve requirement that is set by the Fed. And that's an important part of the way in which the Fed regulates commercial banks. And the Fed is also a lender of last resort. The Fed can loan money to commercial banks. The Fed isn't out there loaning money kind of all the time on a normal routine basis. The Fed is a lender of last resort. So the Fed is there to loan money when the economy's not going so well or when the financial system is having trouble. We'll talk more about that later in the course, even later in this chapter. But for now, just know that's one option or one activity or one role of the Fed. Now, the rate of interest that the Fed charges commercial banks is called the discount rate. So if you're a commercial bank, you have to borrow from the Fed. The rate you pay is called the discount rate. Obviously, that's a rate that's set by the Fed. The discount rate is not appropriately named. Discount rate would make you think that the rate is low, right? It's a discount. It's a good deal. It's a lower rate. But that's not the case. The discount rate is actually higher than what the bank would normally charge or would normally pay if it's borrowing money from another bank. So the discount rate is actually the premium rate. It's actually a higher rate than the bank would normally pay. but it's got this weird name. I don't know where it comes from. It's been that term discount rate has been around for decades and decades, if not a century maybe. But I don't know where it comes from, but it's not a discount, it's a higher rate. And then the last part is the Fed conducts monetary policy. And that's what we're going to focus on in this course pretty heavily, monetary policy. Monetary policy, we mean the Fed can actually manipulate the quantity of money that we have in our system. And by doing so, they can affect various macroeconomic outcomes. They can affect interest rates, and they can affect broader economic outcomes like unemployment and like inflation and like GDP even through various mechanisms. So that's the biggest role that the Fed plays as far as this class is concerned. We're going to spend a lot of time talking about monetary policy. And the Fed has even been taking monetary policy action just recently. So not only will we be talking about this in the abstract, but we'll be talking about it in terms of, stuff that's happened since March. So, it's current events. The organization of the Fed, most countries have just a central bank, right? In England, it's the Bank of England, and in Japan, it's the Bank of Japan, and so on and so forth. But in America, it's a less centralized system to some extent, because it's not just one entity. It's the Federal Reserve System. So it's comprised first and foremost of 12 regional banks. Countries divided into 12 regions. You can see the map in the textbook that kind of lays out those regions, and each region is served by a specific Federal Reserve Bank. Here in all of West Virginia, except for 4 counties, we are served by the Federal Reserve Bank of Richmond. Now that's weird that the 4 counties, it's actually the 4 counties of the Northern Panhandle, if anybody in here is from the Wheeling area, the 4 counties of the Northern Panhandle actually connect to the Federal Reserve Bank of Cleveland. It's weird that like a state wouldn't just be in one district, but that's the way it is. But there's the 12 regional banks, and then there's the Board of Governors. The Board of Governors has 7 members sitting on it. Those members are appointed by the president, confirmed by the Senate, kind of the normal kind of executive branch structure there, where you have the president appointing members and they're confirmed by the Senate. And of course, the Board of Governors is located in Washington. If you go to Washington, if you go to the Vietnam Memorial, actually, if you look north from the Vietnam Memorial, you can see the Fed Board of Governors building pretty close there. Oh my Lord, I'm about to have a heart attack. My slide has not been updated. Geez, sorry about that. Then we also have what's called the Federal Open Market Committee. Federal Open Market Committee is kind of key for this class because the Federal Open Market Committee is the entity specifically that conducts monetary policy. That's the entity that kind of decides what to do before, what I said before with manipulating the quantity of money in the system and using that approach to affect broad macroeconomic outcomes. Federal Open Market Committee is made of 12 members, the 7 members of the Board of Governors, plus 5 of the regional bank presidents. And those regional bank presidents' seats just rotate. It just rotates among the 12 regional bank presidents. The New York Fed is always on the FOMC, but then the other 4 slots rotate among the other 11 banks. The Fed chair now is a man named Jerome Powell or Jay Powell. The really cool thing is he came here and visited West Virginia University and gave a speech about a year before he became Fed chair. It was super cool, super awesome. I actually had lunch with him. I sat like right next to him for lunch just about a year before he became Fed chair. So, him coming to West Virginia University, it did so much to boost his resume that he gave a speech here that, he just had to become Fed chair. That was super cool. Now we're going to talk about the money creation process. This is really important. This is a key point of this class. So I want you to imagine, for starters, this really kind of simple scenario. We'll talk later about how this plays out in the real world, but the simple scenario will make the point. It will communicate the point that you need to know. So imagine that you dig up a $100 bill from your backyard. Suppose your grandpa buried this $100 bill in your backyard 100 years ago, and it was back there and we forgot about it. And for all practical purposes, the $100 bill was outside of the economy. It wasn't part of the economy. It had been in the backyard for decades. So you dig it up. You're like, oh, here's a $100 bill in an old jar. You go and deposit that money into the bank. That's really new money going into the banking system. That money hadn't been in circulation. It's new money going into the banking system. Assume the banks hold 10% of their deposits as reserves, and assume people don't hold any currency. Obviously, people do have currency, a lot less than they used to have, but people still have some currency. But this model can easily be accounted for the fact that people have currency in the real world. That doesn't change the point either. Anyway, this is what the balance sheet will look like for the bank. You know, just for simple kind of structure here, assume you're just depositing your money in First National. When you deposit your $100 bill there, from the bank's perspective, that's a liability. That's going to show up on their accounting statement as a deposit of $100, a liability from the bank's perspective. Now, immediately, we'll have reserves of $100 on the asset side of the balance sheet. But of course, the bank is not going to just sit on those reserves forever. The bank will loan out most of that money. We assume the bank will loan out 90% of that money. And this is what First National's balance sheet will look like, you know, once it's had time to make those loans. You've introduced $100 into the banking system. It's a $100 liability from the bank's perspective. Bank maintains reserves of $10, and the bank loans out the remaining $90. Those are both assets from the bank's perspective. But this money was loaned out to somebody. Suppose it was loaned out to somebody to go buy a car. That person goes, buys a car, and then the person who sold the car to them, they deposit the $90 into their bank. Right? That $90 doesn't just disappear. It went to somebody else in the economy. That person puts it into their bank. So suppose that person banks at Second National Bank. That deposit is going to be, you know, $90 in deposits, $90 in liabilities from Second National Bank's perspective. Second National Bank will keep reserves of $9, and they'll loan out $81. Do you already see where I'm going with this? That $81 is going to go back into the economy. Somebody's going to get it. Somebody's going to put it back into their bank. Suppose that third person deposits it into Third National Bank. Third National Bank now has deposits of $81. They keep $8.10 on reserve. They loan out $72.90. Just think about this. The first person in this chain has $100 in the bank. The first person has $100 in their checking account. The second person in this chain has $90 in their checking account. The third person has $81. The fourth person has $72.90 in their checking account. We have money that has been created. I mean, how insane is that? This is called the money creation process. Just the very nature of the banking system, the way the system works, just the way we have this iterative process of money is deposited into the bank, money's loaned out, that money gets deposited back into the bank, most of that money's loaned out, that money gets deposited back into the bank. This process that we have, this continual process of depositing money into the bank, loaning it out, depositing it back, loaning it back out again, that process creates more money in the economy. In this scenario, with $100 being deposited into the banking system that came from outside of the economy, assuming people don't have any currency, assuming that the banks keep 10% of deposits as reserves, we find that $100 deposit, if you follow this process onto infinity, you could go back to your math class and talk about adding up an infinite series if you want to. I can't give you a lecture on how to add up an infinite series, but that's something that you can do in math class. Anyway, if you follow this logic onto infinity, you'll find that the total money supply increases by about $1,000 as a result of this one $100 bill being put into the banking system. Isn't that incredible? Isn't that fascinating? I think it's very interesting. We kind of quantify this relationship with what we call the money multiplier. As you see there, the amount of money the banking system generates with each dollar of reserves. The simple money multiplier is just 1 over the reserve ratio. 1 divided by the percentage of deposits that banks keep as reserves. This is the simple money multiplier because it can be adjusted to account for required reserves versus reserves that banks keep that are above that minimum required amount. Because so we have required reserves and excess reserves. And then it can also be adjusted for currency holdings. But those things aren't complicated, so we're just going to stick with the simple money multiplier, 1 over the reserve ratio. In this example, the money multiplier is 10, right? It's 1 divided by 0.1. We were assuming that banks kept 10% of deposits in their reserves, so the reserve ratio is 0.1. So the money multiplier is 1 over 0.1, so that's 10. And the way that you kind of work with this equation is here. The injection into the banking system, how much money was injected into the banking system in the first place, times the money multiplier equals the overall increase in the money supply. In this example, $100 goes into the system, money multiplier is 10, we get an overall increase in the money supply of $1,000. That's super cool, super interesting. Now here's kind of the downside. Banks, they know that money's coming in every day and they know that money's going out every day. And banks will keep reserves above and beyond what is required to account for what they normally expect to go out of the bank every day, right? I mean, if we expect that today we're going to have $1,000 leave the bank with people withdrawing money, then, we'll keep excess reserves in that amount just so we're in good shape, just so we're cool. But what would happen if everybody went to withdraw their money at the same time? Go back to this picture. You can imagine this is just one bank, right? We use different banks in this story, but it could just be just one bank. It doesn't matter. The point wouldn't change. So in each iteration, here we have $100 in cash that the bank owes somebody. Here we have $90 the bank owes somebody, $81 the bank owes somebody. But the bank has only kept on 10 and 9 and 8.1 and 7.9. The bank has only kept on, or 7.2, whatever it was. The bank has only kept on a small fraction of that money as reserves. So if something weird were to happen, and if a bunch of people were to go to one bank, and if they weren't able to, if I'm just going to take my screen share off because I'm going to tell this story and we don't need that one little thing up on the screen. If something were to happen, and if everybody were to go to this one bank at the same time and try to withdraw their money, the bank wouldn't have it. The bank accounts for normal withdrawals, but the bank doesn't have all that money. So if something unusual were to happen, if everybody were to go to one bank to withdraw their money at one particular time, what do you think that bank would do? The answer is that bank would just borrow from other banks. That happens all the time. It just happens. It's just random chance that some banks are going to have unusually high withdrawals one day. Some banks are going to have unusually low withdrawals one day. And as that happens, banks can lend and borrow to each other to kind of smooth that out over time. That's called the federal funds market, the market where banks are borrowing and lending to each other on a very short-term basis. And it's no big deal. It's just a normal kind of thing. But what would happen, though, instead, if something happened in the economy and if people just became fearful of the banking system? People were worried that somehow something was going to happen and people weren't going to get their money back. You deposit your money in the bank and it just disappears somehow. I'm not going to go into the full story behind how that can happen, but just for now, assume that happens. So it's not just one bank, but everybody wants to go to get their money out of every bank. Well, normally, if that were to happen, the banks would just shut down. And if the banks just shut down, that would be catastrophic for the economy. That has happened before. That has been catastrophic for the economy. That's a horrible, horrible thing. But now the Federal Reserve can come in and they can loan money to banks to help them through this bank run or this bank panic. That's what that would be called. If everybody wants to go to the bank and withdraw their money at the same time, that would be called a bank run or a bank panic. And the Federal Reserve is there as a lender of last resort, and they can help support the banks during that crisis. And that can help prevent the banks from falling into, or can help prevent the economy from falling into a major crash. Now, another piece of that puzzle, which I'm going to talk about later in the course, is the Federal Deposit Insurance Corporation. That's another issue that does even more to prevent a bank run or a bank panic from happening. Right now, I'm just talking about the Fed. If you want to, you can look at FDIC insurance and read about that as well, or you can just wait for us to come back and talk about it later in the course. Anyway, that's the issue with bank runs. The last part is this issue of monetary policy. How does the Fed conduct monetary policy? The answer is the Fed uses open market operations to maintain its desired outcome regarding the money supply. Open market operations are this. So the Fed owns a huge stockpile of U.S. government bonds. We talked about bonds last chapter. The Fed owns a huge stockpile of bonds that have been sold by the U.S. Treasury at some point in the past that are floating around in the economy. The Fed owns a good chunk of those, like over $1 trillion. And banks own U.S. government bonds as well. If you look on bank balance sheets, kind of a standard item to find on their assets, among their assets are U.S. Treasury bonds that have existed that banks are just holding. And so it's common for these entities to buy and sell these bonds as various things happen in the economy. So think about this. If the Fed goes and buys a bond from a commercial bank, money goes from the Fed into the bank, and then the bond leaves the bank and goes into the Fed. Now, the bond is not money. The bond is a promise to pay money at some point in the future, but it's not money today. And money that the Fed has, that's kind of a fuzzy notion because the Fed is the monetary authority, but just go with me for simplicity. Money that the Fed has is outside of the economy. So if the Fed buys a bond from a commercial bank, again, we're not talking about a bond that the commercial bank is selling on the bond market to finance expansion. We're not talking about primary markets. We're talking about treasury bonds that the bank has been holding for a long time, as part of the bank's kind of savings or reserves, and the Fed buys that existing bond in the secondary market. We're not talking about selling bonds to finance capital investment at all. This has nothing to do with that, which is what we talked about last chapter. Anyway, the Fed buys this bond from a commercial bank. Money goes into the banking system. That money had been out of the banking system. It had been outside of the economy for any practical purpose. That's an injection of money into the banking system. The notion of finding this $100 bill in the jar in the backyard, that injected new money into the banking system, the result is the same if the Fed buys a bond from a commercial bank. That's putting new money into the banking system. That's a big deal. If the Fed buys a bond from a commercial bank, that's called an open market purchase. That's injecting new money into the banking system. That's going to increase the quantity of bank reserves. Banks are going to loan that money out, and the money creation process will follow. In reverse, if the bank sells a bond to a commercial bank, money is leaving the banking system. The money creation process works in reverse. So if the Fed wants to increase the money supply, it conducts open market purchases, buying bonds on a short-term basis from commercial banks. If the Fed wants to reduce the money supply, it conducts an open market sale, selling bonds to commercial banks on a short-term basis. Now, here's a question for you. Members of the FOMC, remember, this is decided upon by the Federal Open Market Committee. Members of the FOMC decide the money supply should be increased by 100,000. What do they do? Reserve ratio is 5%, and we assume the individuals hold no currency. Now, we say they decide the money supply should be increased. And we're going to talk in a couple chapters why that would be the case. So we're not going to discuss right now why we would do this. We're just going to discuss how we would do this. In a couple chapters, we'll talk about the why part. But okay, so for whatever reason, we decide that we need to increase the money supply by 100,000. We know the reserve ratio is 5%. We assume that people hold no currency. And again, we can account for those things for a more realistic scenario. What do we do? So I want you to solve that on your own. Pause the video, solve it on your own. Okay, now you're back. The Fed would buy 5,000 in Treasury bonds. The Fed would buy 5,000 in Treasury bonds from commercial banks. If the Fed buys 5,000 in Treasury bonds, that's going to inject $5,000 into the banking system. In this case, the money multiplier is 20, right? It's 1 over 0.05. 1 over 0.05 is 20, so the multiplier is 20. So we put 5,000 in new money into the banking system. Money creation process will happen. Multiplier will be 20. That 5,000 will translate into a new $100,000 once it's had time to adjust, once the system has had time to adjust. That's how the Fed operates. If the Fed wants to increase the money supply by 100,000, it buys 5,000 in Treasury bonds from commercial banks, within this scenario with these parameters. If it wants to reduce the money supply, it sells bonds using the same formula. Now, the Fed can also alter the money supply in other ways. The Fed could change the discount rate, or the Fed could change the reserve requirement. The Fed doesn't do those things. The Fed could do those things, but it doesn't do those things on a practical basis. I just want you to understand that those things would also change the quantity of money in the system. But I just want you to read the book. To keep this video brief, I want you to read the book and understand how those parameters would also affect the quantity of money in the system. But what our focus is open market operations, open market purchases, and open market sales. Okay? Anyway, that's it. That's a big chapter. You'll see really quickly, we're going to talk about the Fed every day from here on out. They're going to be a really big part of this discussion from here on out. But I think now you have a pretty good introduction into what the Fed is and how it operates. Talk to you next time.